Abel, thank you so much for joining us today. We really appreciate you taking time to come and really inform our viewers about the situation with Section 24. So, Abel, to kick things off, please could you just give us a summary of what Section 24 actually is and how the changes have impacted landlords?
Yeah, excellent. Thanks for having us. We appreciate the opportunity. Yeah, so Section 24 has been with us for nearly 4 years now. And in terms of the main impacts of that law, it's essentially it was introduced to enable the government, in effective terms, recuperate more tax, curb the property rises in the buy-to-let market, increase the property stock available for new buyers. In terms of its impact on landlords, it's been that landlords are having to pay more taxes in effect. And this has come about as a result of restriction of mortgage interest or finance cost available for landlords in terms of deductions from their rental income. So the net effect is landlords are having to pay more taxes and when they file their tax returns and what have you. So I would say the gross impact is they're having to pay more taxes and due to the restriction of mortgage interest.
Okay, thank you. And so in terms of landlords who are concerned about this, I'm guessing well, we know that there are options for them in terms of other structures. So
Yeah.
perhaps you could just talk us through some of those structures just now, please.
Yeah, sure. Thanks for a very good question. In terms of obviously the options available, most landlords find themselves in a situation where they own a buy-to-let business, which are mostly unincorporated, i.e., they operate on a sole trader basis, or in some cases a partnership. Most landlords didn't think about this in the long term and haven't set up corporate structures. In terms of the options available, those who currently have their properties located or incorporated in a limited company would obviously continue to do so because that is the most, should I say, most tax efficient avenue. In that most limited companies are still allowed to deduct interest from their rental income. For landlords who find themselves in a situation where they are still a property business or an unincorporated entity, there are a few options out there they could potentially look at. One of the options would be potentially getting a partner involved, i.e., could be a wife or a family member who is on a lower income, and thereby spreading, should I say, the income to avoid the high rate impacts on the law from the law. The other options would potentially be to move your portfolio from a residential portfolio to, let's say, a commercial portfolio. In that most commercial properties, you're still allowed to deduct interest, as the case may be. There's also another option. You could potentially set up your own property management company. And what that literally entails is you'd be in a position whereby you'd be able to, should I say, scoop up some of the profit that would have ended up being taxed on you as a sole trader into that management company. And then, of course, pay corporation tax on that profit.
Right.
Another option, which I'm sure we've all heard of, is known as the rent-to-rent option, where typically people come in, and that's more especially for HMO landlords. The way it works is literally you could set up your own rent-to-rent company and then let's lease out all your properties on a single let basis to the rent-to-rent company. The rent company then obviously manages your property as a HMO. The difference between the rent-to-rent option and the management option is that you'd be able to obviously charge a higher management fee, as there are limits to how much you can charge as a pure management company. That with a rent option, you'd be taking on a lot more responsibility. So that way, you'd be able to take a larger chunk of that profit into a limited company setting. The other option, which obviously it's a little bit controversial, but most property businesses are now using it, is the obviously beneficial interest company trust, which essentially means you would literally pass on the beneficial ownership of your company to a new limited company. And that limited company declares the rental income, pays you the mortgage interest, and then, of course, most of the profits are ultimately moved away from you into a limited company. So, in summary, these are some of the options available to landlords who are potentially find themselves in this situation.
Sure, thank you. And I think really what I would say at this point is that there's obviously lots of options. So getting really good advice from a tax advisor is really important. And
Definitely.
interestingly, when you mentioned the beneficial interest company trust structures,
Yeah.
because I know that accountants and tax advisors think they're very, very good, but mortgage lenders really don't like them. So we've got
There are
clients.
issues.
Yeah,
Yes, there are potential issues with it. Obviously, it's still very new, and it's it's untested. We don't know HMRC's view on it ultimately, and I suspect from a lending perspective, there are issues already.
yeah,
But
yeah,
I feel every situation would have its own solution. So it would very much be a function of your own personal situations. There are clients we've advised in the past who had probably one or two properties, and we've advised them to just keep them their names. Others who have plans of setting up larger portfolios, you're well advised to start using a limited company. And those who want to incorporate, i.e., move all, everything from their existing sole tradership business into a limited company structure. So every situation, every solution would demand obviously a specific investigation into the affairs of that individual to
yeah.
recommend suitable advice.
Yeah, I think that's absolutely key, isn't it? Is speak to a tax advisor, but also then speak to a mortgage broker and make
Definitely,
sure that the two marry up and it works in the round rather than just focusing on tax or mortgages. And so moving
exactly.
sort of more specifically onto limited company structures. So
Yeah,
as a business, we're seeing a huge, we have seen a huge swing in terms of the number of people using corporate structures to acquire property. That's reflected
exactly.
across the whole market.
Yeah,
So perhaps it would be really great if you could just explain to us first of all, how you're actually taxed when you use a limited company for
limited
your
company structure.
investments.
Yeah, excellent question. So we all know what's happening now. People obviously moving away from sole tradership type of structure as far as their property business is concerned. With the limited company structure, the main attraction here is most limited companies are taxed, or small limited companies are taxed at 19%. So, and the main advantage here is you're able to deduct your mortgage interest. So, strangely, the government decided it would only apply to individuals and not to limited companies. So, the long short is you'd obviously prepare your accounts, pay your corporation tax returns. The company would show a profit, and that profit will be as a result of deduction of mortgage interest from your rental income. Whatever profits you end up in that company, you'll be taxed at 19%, depending on the size of the company. But for most small businesses, it's 19% of the property income.
That's corporation tax,
That's
yeah?
corporation tax, exactly. The advantage here for corporation tax, for you running your business through a limited company, is unlike your sole tradership structure. If you don't personally draw money out from that business, you won't suffer any personal income tax liability. So that is the main. There are significant tax advantages with going to a limited company. It offers what is known as a tax sheltering. So, for instance, if you were already employed elsewhere with significant amounts of income, and you were running your property business through a limited company, you offer that opportunity not to get taxed on every single penny as you would have been if you were running a sole tradership type of structure. So there are significant tax advantages. If you don't actually personally take any money out from the business, you won't suffer any income tax, even though the company bears corporation tax rate. But that will be at a significantly lower rate of tax, i.e., 90%, compared to what you would have paid at 40% or 20%, as the case may be.
Perfect, thank you. That's a good explanation. And I suppose that really leads me on to two questions. So first of all, using the limited company sounds really positive. I mean, is there any cons to using it? Is there any downsides?
Unfortunately, there are. And it's always a function of your personal, as we've already indicated, it's always a function of your personal situation and your circumstances. Let me put it that way. Not This structure might not be suitable to every single type of business. So to give you an example, if for instance you had one or two properties, you didn't have any other source of income, and your properties were your main source of income, generally our recommendation would be there's no point in incorporating. I run your property through a business, a limited company. There are you probably back me up on this. When it comes to limited company mortgages, the interest rates are much higher than going for a mortgage personally.
Yeah,
The borrowing costs are much higher. You do tend to get higher LTVs, but it comes at a higher interest rate. There is compliance cost with running a limited company. So what I mean by that is with a sole trader type of business or unincorporated type of business, there's in terms of the compliance requirement with Companies House and HMRC, it's very low. However, with a limited company, you would have to file your corporation tax return, the annual accounts, confirmation statements, and it's a whole raft of legislation, especially from the Companies House perspective. So the compliance burden is slightly much higher.
Yeah.
It's not a relaxed regime, unlike the unincorporated entities. There are also there's a potential for double taxation. So what I mean by that is obviously any income earned by the limited company in the form of profits will be subject to corporation tax. In the same vein, if you then take money out from that company, you would end up with income tax liability as well.
Right.
So depending on your situation, some cases, if the plan is not to take money out and then you'd only use as a retirement fund of some sort, it works brilliantly. On the other hand, if you were in a situation whereby you're already a higher rate taxpayer and you draw money out in the form of income, that double hit could be potentially not tax efficient. There are other things like capital gains tax. So in a limited company, if you sold your property, typically you'd pay corporation tax at 19%. And then, of course, those funds will be in the limited company. So to take those monies out, you'd end up with another form of tax. Depending on how you take the money out, if you take it as a dividend, it's income tax. If you take it out as a capital gain, you're going to end up with the tax rates, either 10%, 18%, or whatever, depending on your marginal tax rates. So it's not it's really a function of your individual circumstances, but generally it offers a higher tax efficiency, compared to the sole tradership or unincorporated structure.
Thank you.
Especially with this new regime of
Yeah.
Section 24.
Thank you. And the other question, which you've kind of touched on already, is that in terms of getting money out of the limited company, so I've got my limited company, I've built up a nice amount of of cash in there, I want to have some of it out. How would I access that, and what are the tax implications of that as well, please?
Yeah, that's awesome. That's a good question. So in terms of taking monies out from your limited company, there are a few options. Typically, if you did incorporate your property business, so for instance, moved it from your existing structure, in most cases, you'd end up with what is known as a loan account. And it's essentially all the equity you have in your property. You'd literally lend it to the company. So most incorporated property business, or even those running it through, setting up their own property businesses and running it through, most of their deposits are self-funded. So you typically going to end up in a situation whereby you've got a large chunky loan account in the limited company. If you find yourself in that situation, drawing down that loan is not taxable. So it's essentially a loan repayment from your company to yourself. So it could be one means of obviously taking money out from the business. The other option will be dividends. So dividends, typically, it's obviously a return on your investment. So as a business owner, the company can pay you a dividend. Dividends are fantastic in the sense that there's no national insurance when you draw a dividend from your business, unlike other forms of income like salaries and bonuses. There's no national insurance on dividend, and that's the main attraction with dividends. They also have a tax-free allowance of £2,000. So regardless of your rate of tax, you can draw out a dividend. The tax rates on dividends are quite low as well. The first 2,000 is tax-free. Then the next 37.5% comes in at 7.5%. And then you go into 32.5%. And then if you're an additional rate taxpayer, it goes on and on, basically about 38.11%. So dividend offers you could obviously take a salary. But again, these are a function of your individual personal tax circumstance. If you're already in a high income employment, perhaps you might not need the sum and you could leave it for when you retire. In which case, when you retire, your source of income would probably be nil if you've got some pensions and some other forms of income. Generally, your tax rates will be lower. At which point, if you've got an accumulated amount of cash in the business, you can obviously take it out and suffer a much lower tax rate.
The director's loan, the director's loan account. So say I
Yeah,
bought a buy to let, I put some money into my limited company from
yeah,
my own personal reserves and set up a director's loan account to do
yeah,
so.
yeah.
Is there a restricted amount of time for me to be able to draw that money out, or is it as long as the company is in existence and it owes me that money, I can take it back?
Yeah, so there's no restriction. So it's
Okay,
essentially you've lent X amount of money to your business, and it's up to you when the business pays that money back to you.
okay.
So there isn't any time restriction on it.
Okay,
Yeah,
perfect. Thank you. And so, look, the other thing we're seeing lots of at the moment is incorporation. So, the
definitely.
process where someone moves property from their personal names into their limited companies.
Yeah,
Um, is there, could you possibly explain to us the process and also the tax implications
yeah,
of doing so? And I know there are different ways of potentially making this transaction happen as well. So, if you
of
could just
course.
talk us
Yeah,
through that. Great, thank you.
yeah. I think that this one here is quite a big topic, and yeah. So what's happening is obviously people have found themselves in this situation, and most of them are literally turning their sole tradership on incorporated businesses into a limited company. The in terms of the meaning of that transaction is literally what you're doing is you're selling your properties to a limited company. So in the same way as you would see Mr. B and Mr. B wants to buy a property and you go in there and sell that property to Mr. B, it is the same way. The limited companies are different legal entities or different legal personalities. So they are not literally you. You have two separate entities. So when you pass on your properties into a limited company structure, you're effectively selling that property to a limited company. And that is a form is known as incorporation in tax law. So to that effect, if you dispose of a property to a limited company, you would end up with capital gains tax. If the limited company acquires that property from you, the limited company would have to pay stamp duty. So effectively, if you do incorporate, what you're effectively doing is you'd end up with these two taxes. The good thing, however, with incorporation is there is something known as the incorporation relief. And what that literally means is the government would say that you owe me capital gains tax now. However, I wouldn't collect the capital gains tax. I'll defer it until such point as you sell the underlying shares you'd acquired on incorporation. So that's one of the main advantages. However, to secure incorporation relief, whatever that entity you have at the moment is, it needs to be a business. It needs to be a property business. So it shouldn't be a passive type of operation. So, for instance, if you had one or two residential properties, single let occupancy type of property, which is a very, very passive like way of business, I would say, you would have a hard time getting HMRC, trying to convince HMRC that it's a property business. So typically, it's more for slightly larger portfolios and HMO type of business where there's a lot of time involved in managing those portfolios. In those situations, you could potentially secure incorporation relief and then, of course, avoid capital gains tax. When it comes to stamp duty, it's different. The stamp duty is not a function of the type of business. It's really more to do with how the that transaction is carried out. So typically, if you run a property, if a partnership disposes of assets to a limited company, there is no stamp duty. So what most people tend to do in the form of planning would be to rather start from a property business, go to an LP structure, and then from the LP structure, go to a limited company structure. So if you go through those forms of these structures, you would end up in a situation whereby you'd avoid stamp duty and, of course, defer capital gains tax. So it's a bit of there are a few steps involved, but if it's done efficiently, you could potentially save yourself those two taxes, which tend to be the major issues. Of course, there are issues. Then you've got other issues with obviously your mortgages, moving lenders, or what have you. But I suppose that's your territory. But yeah, excellent.
Thank you. Yeah, I mean, we're seeing lots of our clients going through the process where they're looking to take incorporation relief, and
Yeah,
I cannot really emphasize enough how important it is to do it properly and get really good
exactly.
advice.
Yeah,
One bit of missing paperwork can be the difference between paying capital gains and not paying it, or it being
exactly.
deferred.
Which
So
could be
yeah,
significant as well. Exactly.
yeah,
Yeah.
absolutely. Abel, I'm out of questions. Thank you so much for
Brilliant.
your help. I've really actually enjoyed listening to everything you've got to say. It's been really useful. I'm sure everyone
Thanks for
watching
having
has
us as
found it
well.
too as well. Yeah, no, thank you so much for your time.
Appreciate it. Thank you very much.
Thanks.